November 20th, 2008. The number on the screen was 80.86. Not a stock price, not a bond yield. That was the VIX, the market's official fear gauge, hitting a level so extreme it had never been seen before in recorded financial history. The intraday high that day was 89.53. For context, anything above 30 means people are scared. Above 80 means people are convinced civilization is ending. And you know what? In October and November of 2008, they weren't entirely wrong. The S&P 500 had already lost 56.8% from its peak. Not 10%, not 20, 56.8% gone. If you had $1 million in a broad index fund in October 2007, by March 2009, you had $432,000. And that's if you didn't panic sell, which, spoiler, most people did. But here's the thing nobody tells you in those "the market always recovers" pep talks. Some people made money. A lot of money. During the worst financial crisis since the Great Depression. While everyone else was watching their retirement accounts turn into a sad little decimal, a handful of assets were doing the opposite. Completely the opposite. And that's what we're going to talk about today. Not in a get-rich-quick way, not in a buy gold and hide in a bunker way, in a let's look at what the actual historical data says way, because the data is genuinely wild. Let's start with the asset that did something so boring it becomes almost funny when the whole world is on fire. October 2007. The S&P 500 is at its all-time high of $1,565. Lehman Brothers is still a functioning bank. Everyone is feeling great. And somewhere, a very boring person, the kind of person who reads bond prospectuses for fun, is quietly buying long-term U.S. Treasury bonds. His friends are laughing at him. "Why are you buying government bonds? The stock market's going to the moon!" 2008 full year, global bonds returned 12%. MFS Investments confirmed that number. Not -12, +12, while the S&P 500 was down 38.5% for the year. And long-term treasuries? Even better. The 10-year treasury yield fell from 3.86% in December 2007 to 2.09% in December 2008. If you don't speak bond, that means treasury prices went up, significantly up. Total return on long-duration bonds for 2008? Plus 25.9%. 25.9. Meanwhile, the stock market was setting records in the wrong direction. And this wasn't a fluke. During the dot-com bust in 2000, 2001, and 2002, bonds posted above 8% returns every single year. Every single year! While the Nasdaq was losing half its value.
Here's the mechanism, because this matters. When the economy crumbles, the Federal Reserve cuts interest rates. When interest rates fall, existing bond prices rise. It's a mathematical inverse relationship baked into how bonds work. And on top of that, scared money flees stocks and runs directly into U.S. Treasuries because they're considered the safest asset on Earth. America defaulting on its debt is historically not a thing that has happened, so demand surges, prices surge, returns surge. The St. Louis Fed documented the stampede in real time. T-bill issuance, the amount of short-term government debt outstanding, went from $1.2 trillion in August 2008 to nearly $2 trillion by November 2008. Investors almost doubled the amount of treasuries they were holding. In 3 months. That's not a flight to safety, that's a full-on panic sprint. But wait, because there's a catch. There's always a catch. 2022. The Federal Reserve, instead of cutting rates, was raising them aggressively to fight inflation. And something that hadn't happened in decades happened. Both stocks and bonds fell at the same time. The inverse relationship that had protected bond investors through 8 U.S. recessions since 1950 broke.
The 60-40 portfolio, 60% stocks, 40% bonds, the most recommended allocation in the history of financial advice, lost money on both sides simultaneously.
So when does the bond play work? When the recession is deflationary or neutral, when the Fed cuts rates in response. When does it fail? When the recession comes with high inflation and the Fed is forced to raise rates. Stagflation. 2022. Pay attention to that word. We'll come back to it. Now, the asset everyone thinks they understand and almost nobody actually does. Gold. People have been talking about gold as a crisis hedge since literally the Roman Empire, and yet, somehow, every time there's an actual crisis, gold manages to surprise everyone, including the people who bought it to protect against crises. March 2008. The first signs of real financial stress are emerging. Bear Stearns is wobbling, and gold does something it has never done before. It crosses $1,000 per ounce for the first time in history. The market's fear radar is flashing. Gold is picking up the signal. Then, September 2008, Lehman Brothers collapses. The panic is now total, and gold dips. Wait, what? The supposedly invincible crisis hedge dips during the crisis? Yes, because when pure panic hits, the kind of panic where hedge funds and banks are forced to liquidate everything to cover losses, gold gets sold too. Not because people don't want it, because they need cash, right now, yesterday. But this is where the story gets interesting. Gold entered 2008 at around $850 per ounce. It closed the year at approximately $870, essentially flat, in the single worst year for equities in modern history. While the S&P 500 lost 38.5%, gold lost nothing, zero. That's not doubling, but it's also not losing half your money, which in 2008 counts as a miracle. And then the second act. The Federal Reserve starts pumping money into the system. Near zero interest rates, quantitative easing, more money creation than anyone has ever seen in peacetime history. And gold starts moving. $870 in 2008, $1,000 in 2009, $1,500 in 2011, and on September 5, 2011, gold hits $1,895 per ounce, a confirmed all-time high. From its 2008 level, that's a 117+% gain. There's the double. It just took 3 years to arrive. Now let's go back further because the Great Depression story is even wilder. 1929. The Dow Jones Industrial Average has risen sixfold. 6 times. From 63 in August 1921 to 381 in September 1929. The economy is booming. Irving, one of the most respected economists in America, tells the New York Times on October 16, 1929, that stock prices have reached what he called a permanently high plateau. 13 days later, Black Monday, October 28, 1929. The Dow falls nearly 13% in a single day, and it doesn't stop falling for 3 years. By the trough, the Dow had lost 89.2% of its value. 89%. During all of this, the government-fixed gold price sat at $20.67 per ounce, completely stable, while everything else imploded. But here's the part that the gold bugs conveniently skip. In April 1933, Franklin Roosevelt signed Executive Order 6102. Americans were required to surrender their gold to the Federal Reserve at $20.67 per ounce. No negotiation, no market price. Hand it over. And then, the Gold Reserve Act of 1934 repriced gold to $35 per ounce, a 69% increase. But that gain went to the U.S. Treasury, not to you, not to the people who held the gold. Private gold ownership was illegal in the United States from 1933 to 1974. 41 years. The gold saved you from the Depression, and then the government took it. The historical case for gold isn't gold doubles in a crisis. It's more precise than that. Gold preserves purchasing power over the long arc of a crisis, and it responds to the monetary policy aftermath, the money printing, more than to the crash itself. That's a completely different thing, and it matters enormously for how you think about it. All right, let's talk about the most boring-sounding assets on this list that quietly just didn't die. Consumer staples, food companies, soap companies, the corporation that makes your paper towels. And yet. October 9th, 2007 to March 9th, 2009, the full S&P 500 peak-to-trough collapse. Out of the entire S&P 500, every stock in it, only 10 companies posted positive returns. 10 out of 500. And the ones that made it skewed heavily toward companies selling things people cannot stop buying regardless of whether the economy is on fire. Walmart, full year 2008, plus 18%, while the market lost 38.5%. Dollar Tree was among the best performers because when times get hard, people don't stop buying things, they just start buying cheaper things. That's the whole secret. Inelastic demand. People still need to eat. They still need dish soap. They still need toilet paper. The recession doesn't change the physiological requirement for toilet paper. The Consumer Staples Select Sector ETF, ticker XLP, returned negative 15% in 2008. And I know what you're thinking. Negative 15 is still negative. True, but compared to negative 38.5%, that gap is the entire game. Here's the math that breaks people's brains. If you start with $1 million and lose 38.5%, you have $615,000. To get back to $1 million, you need a 62.6% gain. But if you only lost 15%, you have $850,000, and you only need a 17.6% gain to recover. Same crash, completely different recovery. The difference is $525,000 over a 3-year window, from doing less bad. The dot-com bust makes this even cleaner. 2000 to 2002, the S&P 500 fell 22.3% annualized. Consumer staples returned plus 11.2% annualized over that same period. Procter & Gamble, Coca-Cola, Altria, they just held, while the entire technology sector was being vaporized. And during the dot-com crash, consumer staples were also paying 3 to 5% dividend yields, so you were getting paid in cash while the market disintegrated around you. The accurate framing here isn't consumer staples double in a crash. It's more like consumer staples are the financial equivalent of wearing a seatbelt. You don't arrive faster, but in a crash, you arrive. Now, the most dangerous asset on this list, by far. Inverse ETFs. Let me explain what these are because the concept sounds almost too good. An inverse ETF is designed to go up when the market goes down, perfectly inverted. SDS, the ProShares Ultra Short S&P 500 ETF, launched June 21, 2006, just in time for the 2008 crash. It's designed to return twice the inverse of the daily S&P 500 performance. Market down 1%, SDS up 2%, in theory. The S&P 500 fell 38.5% in calendar year 2008, so theoretically, SDS should have gained somewhere in the range of 74 to 80%. That's the double. That's the story the headline tells. But now, let me tell you the story the headline doesn't tell. Compounding decay, also known as beta slippage, also known as the reason why inverse ETFs are explicitly labeled as short-term trading instruments by every single issuer. Here's how it works. Market falls 10% on Monday. Your negative 2x inverse ETF gains 20%. Great. Market recovers 11% on Tuesday, which brings it almost back to where it was, but your ETF loses 22%. You're now worse off than before both days. The volatility itself is eating your returns, daily, every single day. The CVOE documented a specific example during the 2008 crash that makes this concrete. Between November 28 and December 5, 2008, the iShares U.S. Financial ETF moved from $44.98 to $45.35, essentially flat. The double short financial ETF, SKF, should have returned roughly zero. Instead, it moved from $135.05 to $117.18, a loss of 13.2%. On a short ETF, during a week when the underlying asset went nowhere. The VIX, that fear gauge we opened with, peaked at 80.86. That extreme volatility is exactly the environment where compounding decay is the most catastrophic. The more volatile the market, the faster inverse ETFs bleed. Michael Burry's famous 2008 trade, the one from The Big Short, was credit default swaps on mortgage-backed securities, not an ETF, not anything close to an ETF. Inverse ETFs are a retail approximation of a trade that sophisticated institutions do completely differently, with completely different mechanics, with completely different risk profiles. The inverse ETF can double in a crash. It can also go to near zero in a whipsaw market. And the most volatile markets, the ones most likely to trigger your "I need to short this" instinct, are the ones most likely to destroy inverse ETFs through compounding. This isn't a flaw, it's by design. The only scenario where inverse ETFs work reliably is the market falls steadily in one direction with low volatility over a short period of time, which is also almost by definition not what market crashes look like. And finally, the asset that doubles in a way that makes economists uncomfortable to even describe out loud. Cash. Yes, cash. The thing sitting in your checking account right now. The thing financial influencers spend 15 videos a week telling you to get out of because cash is trash and inflation eats your savings. Here's what the data actually says. August 2008, T-bill issuance outstanding, $1.2 trillion. November 2008, nearly $2 trillion. Institutions doubled their cash equivalent holdings in 3 months. Not because they thought cash would make them rich, because losing zero in an environment where everything else was losing 50+% was a rational and defensible strategy. Accepting near zero nominal return for certainty of principle. The Great Depression makes the cash argument even more counterintuitive. 1929 to 1933 in the United States, deflation. Prices falling, the dollar becoming more valuable over time, not less. The Federal Reserve's own Fred database shows the consumer price level peaked in September 1929 and fell to a low in March 1933. If you held cash during that entire period, your purchasing power increased as prices collapsed. The loaf of bread that cost $1 in 1929 cost less in 1932. Your cash bought more. In a deflationary crash, cash is the returning asset. But, and this is the critical flag, cash in an inflationary recession is the exact opposite. June 2022, US CPI hit 9.1%. If you were holding cash that year, inflation was eating roughly 9% of your purchasing power annually. Cash doubling is entirely a function of the type of crash. Deflationary crash, cash wins. Inflationary crash, cash loses. And the tricky part? You don't always know which one you're in until you're already in it. The honest framing is this. Cash doubles relative to equities in a deflationary crash. It doesn't double in nominal terms. It doubles in relative purchasing power, the gap between what you have and what equity investors have. That's a real advantage. It's just not the sexy story. Now here's where it gets interesting, because the research reveals something that even sophisticated investors get wrong. The 2022 anomaly. For 8 consecutive U.S. recessions going back to 1950, bonds provided positive returns. For 8, that historical record is what gave rise to the most popular investment advice in modern finance, the 60-40 portfolio. 60% stocks, 40% bonds. When stocks fall, bonds rise. They offset each other. The correlation is negative. The system is elegant. 2022, the Federal Reserve raised rates aggressively to fight inflation running at 9.1%. Bonds fell, stocks fell, both at the same time. The Shiller-Cape ratio, the cyclically adjusted price-to-earnings ratio that famously predicted the 1929 and dot-com crashes, had already exceeded the 1929 peak of 32.56, and U.S. federal debt to GDP was sitting near 100%, compared to roughly 16% in the early 1930s. This is not a normal starting point. The safety net that worked through 8 recessions was temporarily shredded. The warning sign nobody likes to discuss. All 5 of these crash assets have a hidden dependency. They're not unconditionally safe. They work given specific economic conditions: deflationary recession, Fed rate cuts, a functioning sovereign credit system. Change those conditions, and the playbook changes too. The research isn't telling you what to buy, it's telling you when each thing has historically worked, and why. Those are completely different things. And that brings us to the part where we check today's vital signs. The yield curve has been flashing inversion signals, a pattern that has preceded every U.S. recession since 1955. The VIX moved sharply in 2025 as tariff concerns rattled markets. The Cape ratio remains well above historical averages. Federal debt near 100% of GDP means the government has less fiscal room to respond than it did in 2008, which was already stretched. And the bond-equity correlation, broken in 2022, is not guaranteed to have returned to its historical negative relationship. This is what the people who confidently say, "just buy bonds in a recession" or "just buy gold" are skipping over. The 5 assets we covered today have a combined track record across the 1929 crash, the dot-com bust, and the 2008 financial crisis. That's 3 of the worst economic events in modern history. The patterns are real, the data is documented. The Federal Reserve's own historical archives confirm the mechanisms. But none of it is unconditional, none of it is automatic, and none of it will protect you if you buy the wrong version of the right asset at the wrong time for the wrong type of crash. October 16, 1929, Irving Fisher told the New York Times that stock prices had reached a permanently high plateau. The Dow peaked 13 days later and then fell 89.2% over the next 3 years. He was not stupid. He was educated, credentialed, widely respected, and spectacularly wrong. Not because he lacked information, but because he confused "it hasn't crashed yet" with "it won't crash." That's not a 1929 mistake. That's a human mistake. It's been made before every crash in recorded history. It will be made again before the next one. The assets exist. The data exists. The patterns exist. What doesn't exist is certainty. And anyone selling you certainty about a crash hedge is selling you the one thing that crashes always destroy first. Same story, different decade, same ending. You saw 5 assets that have historically worked when everything else didn't. You saw exactly when they work and exactly when they don't. Most people will watch this, nod along, feel smart for 5 minutes, and then go back to checking their portfolio and hoping for the best. The ones who actually do something with this information are a much smaller group. If you're in that smaller group, you know what to do. Money Never Learns is right here when you're ready to keep going.